Well, it's already been one hell of a ride, and we're only in the beginning stages, it seems. Coronavirus has already affected our market in some pretty drastic ways already. As a result, I'm going to first explain what I'm seeing out there based on my personal observations, as well as my conversations with title company executives, other agents, and new home sales executives. Then I'm going to pose some questions to which we currently don't have answers to, but are likely to adversely affect our market moving forward. Finally, I'm going to explain what market segments are the most exposed, both in the short term and in the long term. Okay, first, let's discuss what we currently know. As a huge surprise to me, we're not seeing many cancellations at this time. I only had one cancellation on a listing and immediately had another offer within a couple of days. Most agents and title company reps that I've spoken to are claiming the same kind of activity. Now, one title rep stated that in the first week of March, she saw more opened escrows and closings than in the entire month of March last year. Now, while much of this activity has been a result of refinancing and pre-coronavirus, still nowhere near the level of cancellations I would have expected. However, it's also very early, and I would certainly expect a massive fallout to ensue in the forthcoming days and weeks ahead. One important indicator has to do with inventory. If you watch my videos, you know that until this week, we had decreasing inventory for 37 out of the past 39 weeks. We've been losing about roughly 150 homes a week on average. Well, this past week alone, we just saw almost a 9% increase in inventory. I just got the report today, right before filming, and this week we're up 13%. What's more dramatic here is that while without question there are tons of new listings, it's a little more pervasive than this number seems. Yes, we netted 373 homes last week, and then we added 600 more homes this week. At first I thought we had a ton of withdrawals, but after I pulled the numbers, we only had 10 more withdrawals last week than the week before that, and then this week about 20 more homes than we had last week. So that's encouraging news for now, but you can count on a ton of withdrawn listings in the near future. Another development has to do with escrow closing. On Wednesday the 18th of March, the county recorder's office officially closed. This means that technically deeds can't be recorded. The good news is that most reputable escrow and title companies are still able to electronically record. Now understand, this is a pseudo recording, if you will. While this is completely legal, it's not quite the same as recording the deed at the county. However, all companies with electronic recording also contain supplemental gap insurance, which covers the property during the time between an e-recording and an official recording at the county, regardless of how long this is going to take. Needless to say, closings will continue completely unaffected. Okay, let's talk on to some real talk. Without a doubt, the economic impact of closures and subsequent layoffs and furloughs will impact the city of Las Vegas by epic proportions. At this point, it's just naive to believe otherwise. Now, what we don't know is to what extent. Right now, it's been estimated that Nevada, Florida, and Hawaii will be the hardest hit states, with Nevada being the worst at 5.3% increase in unemployment right off the bat. If this lasts a couple of months, we should be able to ride this one out, hopefully. But this could easily extend to 5 months based on the Imperial College of London report, which essentially would deliver just a death blow to our economy. I've gone on record as stating that while the government's promise of checks is welcomed, it's also a very small bandage on a very large wound for us here in Nevada. What we desperately need is a mortgage and rent forbearance. Currently, there are no foreclosures or evictions being executed here in Clark County. There's been no date set either with regards to resuming them. So it's been stated already that 39% of New Yorkers will be unable to pay rent next month. Now, I'm presuming that number is relatively equal here in Las Vegas, if not even higher. If tenants stop paying rent to landlords who are still obligated to pay their mortgage, and then these landlords can't evict, most of the investors and landlords in Las Vegas will be in serious financial distress in pretty short time. For homeowners of all demographics, having to pay a mortgage with little to no income for the foreseeable future is just devastating. Right now, this is the most important question as I see it. Will the governor shepherd the people of Nevada and pass this legislation? Will the president and Congress pass measures on a national level? I've seen the memo proposal from Representative Maxine Waters from California, which clearly outlines exceptional measures to essentially just freeze all credit, suspend all forms of consumer and small business credit payments, and prohibit debt collection, repossession, and garnishment of wages during this pandemic. Now, like any bill, there's some pork barrel included in hers and some measures that I just personally don't agree with. However, the crux of this bill is very difficult to dispute with regards to drastically improving the financial health of all Americans here. I can't stress how important these measures would have been for Nevada. I sincerely hope our elected officials start really discussing this more and placing pressure on Washington to create real assistance rather than these nominal handouts. Now, I spoke earlier about electronic recording, which very much satisfies the concerns over being able to actually close loans. However, one issue right now has to do with appraisals. Many AMCs or appraisal management companies have come out and expressed concerns that a lot of their appraisers are feeling quite apprehensive right now about going inside and entering people's homes. At the very least, this is going to delay the loan process across the board. On one hand, we can all understand appraisers' fear. On the other hand, I always believe in just following the money. Now, after everyone's losing income and seeing what's going on out there, I'm pretty sure that most, if not all, appraisers will just get past this apprehension in pursuit of earning an actual living. But what remains is what policy changes might occur. Will banks and underwriters change policy to allow for, say, drive-by appraisals like some lenders did in the mid-2000s? Or will they allow real estate agents to submit BPOs or broker price opinions? Right now, these are just questions that need to be answered. Okay, let's talk about the future. Like I said earlier, so much depends on duration, and then how our government responds with intervention. Right now, it's way too soon to predict exactly what's going to happen. While it's great news that we're seeing very few cancellations on both new and resale homes, people also have a tendency to be a little overly optimistic, and many buyers are simply too vested in their transactions to feel as though they can just walk away right now. Torn between losing anywhere from a few $1,000s of earnest money to, say, $100,000 in the case of some of these new home deposits, you have to understand that many new buyers are just going to ride this out a bit longer to see how it plays out, especially for new homes. If you're already going to lose, say, $20,000 by backing out now, you might as well just wait and see, and then lose the money in, say, 4 months, right? So just because we're not seeing cancellations right now doesn't mean we're not going to see a tidal wave on the horizon. Comparisons to the recession are all but impossible to ignore. But the recession wasn't so blatantly immediate as this is. We know for a fact that increased infections and deaths are only a few weeks away from really hitting peak intensity. Once this occurs, I think you're going to start to see some pretty drastic activity as a result. So what happens then? Well, like I've said countless times over these past few years, anytime you have a market in severe appreciation, buyers tend to make emotional decisions rather than, conservative and sensible ones. I've warned for the past few years that most people are foolishly just believing that the market's just somehow going to increase forever. For countless reasons, this outlook is very dangerous. Unfortunately, we've learned very little since the past recession. Over these past few years, builders have capitalized on low resale home inventory and charged just laughable lot premiums. No one cared because people keep paying, and everyone tends to believe that prices will just keep going up, right? This is the same mentality that buried us during the last recession. Now, while lending policies are vastly different and the extremities are different, the principles are similar in many ways. If you watch my videos, you know I've been highly critical of new home sales. While some areas and builders have been priced more conservatively, others have been utterly laughable. Look at this lot premium sheet for a neighborhood of $800,000 homes in Summerlin. How are the lot premiums higher than the home itself? Keep in mind, this isn't a guard-gated community. It's not a country club lifestyle built around a golf course. It's just a regular gated community of tract homes. But people just keep on buying, so you can't really blame the builders for being capitalistic here. But eventually the chickens will come home to roost. Unfortunately, this just may be that time. See, new homes can charge whatever they want since they essentially create their own comparables. They close the cash buyers first and then create your own comps for the buyers that come behind them with financing. Well, unfortunately, once you place that home on the resale market, now buyers are looking at the overall value with respect to the entire area that home is located in. Some buyers are just willing to spend $500,000 more for a newer home, even if it has no backyard, versus a 15-year-old home with a pool that needs some light remodeling. I've been highly critical of the gap between new and resale homes because times like this will happen. When the market's going up, nobody cares about value. People simply want what they want. If you provide buyers with a vehicle to purchase what they want, more likely than not, these buyers are going to take advantage of it, even if it's a poor financial choice. Now, whether ignorance, greed, or ego is the reason for it, people tend to simply get what they want without regards for consequences. Even before coronavirus, I've been seeing homeowners that failed to sell their 1-year-old to 3-year-old new homes for what they even paid. My concern has always been, this is overpriced already. How much more can this possibly go up from here? Remember back in 2008 to 10, everyone was trying to sell their home. Nobody wanted to purchase until 2011 came around when prices finally started to rise due to a halt of foreclosures and an artificial loss of inventory. Once prices finally started rising, everyone wanted to purchase. Well, depending on the level of government assistance, a ton of people here in Las Vegas will have no choice but to sell their home. The issue becomes this. Even when we lift the quarantine, many people just aren't going to get their jobs back for quite some time. Many small businesses simply won't be able to come back. When prices are rising and the inventory is low, nobody cares. Well, when prices start falling, it becomes a self-fulfilling prophecy. People say, I'm going to hold off and let's see what happens. Well, if everyone holds off, then prices continue to fall, thus reinforcing the problem. If unemployment hits 20%, as it very easily could, you simply won't have many people looking to purchase, and prices will decline as a result. More importantly, buyers will be looking for values now. Everyone's scared to purchase a home that's simply going to continue to decrease in value. The main issue here is this. While zero down loans are a thing of the past, plenty of people purchased homes with 5% down and jumbo loans with only 10% down. So consider this. You purchased a home last year with, say, 5% down. Right now, that home's barely gone up at all. The cost to sell is, say, 7%. If you're lucky, right now you can sell for what you owe and walk away clean. Now, if the market drops only 10%, you're screwed. Either hopefully you have the capital to pay your way out of negative equity, but most likely not, which is why you're selling in the first place, right? So once again, here we go with short sales and then foreclosures as a mean to get out of properties. Initially, this probably isn't likely to affect the low end of the market as much. There aren't many affordable new homes, and the demand is highest at the lowest price point. So while demand will dry up, there will be a decent amount of demand for lower end housing, and you're also dealing with less sophisticated buyers. Depending on the level of decrease, we may eventually see investors actually come back out and start purchasing these lower end properties are rental properties. But once you get up to the $500,000 plus price point, it's going to get bad. Most of the new homes are $500,000 plus. Most of these newer homes are really going to get crushed. Sellers without equity are going to have to short sale or eventually foreclose, while the others who did put down money will just watch it evaporate. The higher the price point, the more exposed you are right now. Remember the recession? Luxury items were utterly worthless. Most people purchasing very high-end luxury real estate, they're cashing out investments. Well, that's not going to happen for a very long time now. So that market is complete toast. To illustrate, I took the past 6 months of sales and compared them to 2010, which is as far back as the MLS data will allow me to go. Now keep in mind that I'm being generous here, since 2008 and 2009 were worse and therefore a little bit more relevant examples for today. But let's look at price points. Remember back in 2010, homes were essentially 50% off. Nonetheless, as you look at this chart, you can see that homes were taking anywhere from, say, twice as long to sell versus 10 times as long to sell as we're seeing today. What's interesting looking back is that both the low end and the high end were the markets that got crushed. Not many people can go 9 months without income and still cover their mortgage. And remember, many of these $700,000 to $1 million plus loans were only 10% down. My guess is that if things get tight, the $700,000 to $1 million plus price point, they're just going to get absolutely slaughtered out there. You're going to see a glut of inventory and little to no demand at these price points. A lot of people out there did very well these past few years. They sold their homes, and instead of rolling all their equity over, they invested some in their businesses, they put 10% down, and then spent the rest on, a nice backyard with a pool, maybe a car. If government relief and unemployment levels aren't stabilized, we're posed for a very grim couple of years while we reset. Now understand, I am not all doom and gloom here. I'm simply attempting to illustrate how delicate our housing situation is right now. Things can go from bad to worse very quickly in this situation. Without proper government intervention and guidance moving forward, we could be compromised. Ultimately, this depends on two factors. Again, assistance and duration. If the government intervenes and provides mortgage forbearances, and this pandemic is stabilized in, say, the next couple of months, we may only see a marginal decline in values, and we could come out of this okay. In either case, I do hope that moving forward, our society, at least for a while, humbles itself and becomes a bit more conservative with regards to spending. If buyers refuse to pay $400,000 lot premiums for non-premium lots, builders won't charge these prices. As a result, we'll have a more stable market moving forward. In either case, Vegas will rebound, as we always do. Thank you for watching, and as we receive more developments, I'll be sure to keep you posted. Stay safe and enjoy the extra family time we have with our loved ones. See you guys all soon.